Now, this is where the game really begins, using that home equity line of credit to pay off your traditional mortgage. And like we said, instead of using the HELOC to renovate, using it instead of going on vacation, you are only using this HELOC called chunking to put larger deposits or larger payments on your mortgage itself. So if you're borrowing, let's say $10,000 from your HELOC, using it to pay the mortgage, now you're reducing that $300,000 balance we talked about down to $290,000, which means eventually over the time frame you would save about $14,000 in interest on the $10,000 that you borrowed. And of course, it means paying off the mortgage roughly 18 months early just by doing it itself. Now, how? It seems like magic, but it is just math, guys. The interest on the mortgage is calculated on a monthly basis to determine how much you owe. The lender multiplies the outstanding balance, which would have been that $300,000, dividing it by 12. So the first mortgage payment, of course, is $1,265 with $750 going to principal, which is kind of crazy, or excuse me, $750 going to interest. And the remainder, the very small remainder, is going to principal. Again, even at a lower rate. As you chip away on the balance with your regular payments, the principal comes down, meaning that when you make your monthly payment, you're going to have more going towards principal, less going towards interest as the principal or the mortgage itself does reduce the balance. This is called amortization, and you can speed it up by paying extra money, which in the case is where the HELOC comes in. So step number 4, once you take that HELOC, you borrow that $10,000, you put it on the mortgage, you have to get your HELOC balance down to 0 ASAP. Now, the reason for this is HELOCs are really built a little bit differently. Now, paying on the mortgage with the HELOC, you're moving money from debt to money for debt. This, of course, can be a really big red flag for most people, but Velocity Banking, this is where the magic comes in. Because the home equity is revolving, it means you can pay it back, reuse it whenever you want to. Interest payments are calculated using the daily average balance, which means, like I said before, if you borrow that $10,000 on the HELOC, let's say during the month you make a $4,000 payment, you're only paying the remaining balance or the daily balance on the $6,000 that is remaining on that HELOC. Interest payments, again, are calculated on a daily basis. So when you start looking at Excel spreadsheets, when you start doing calculation, the lower the balance you can get it, the faster, the less you're going to have to pay for the HELOC, which we know is not true for the mortgage because it's only on a monthly basis. So whatever cash you have, every penny you have left is going right onto that HELOC balance and getting it as low as possible. To keep it lower for longer, I'm putting extra expenses, and this again, where credit cards come in,